Hey everybody, I'm Rob Freeman and welcome back to Insuring the Built Environment. This week we're answering the question, what is surplus lines insurance? Well, surplus lines insurance is a specialty type of insurance market that is not required to follow the state insurance regulator guidelines for things like pricing and the types of insurance risks that they can underwrite. So because surplus lines insurance carriers are not required to follow the state insurance guidelines, they have greater flexibility in the ability to write specialty risks that don't have a lot of actuarial history, and they're also able to be more flexible in the pricing that they provide and the way they charge for that coverage. So it's important to recognize that surplus lines insurance can also be known as non-admitted or excess lines insurance. Now, when some people hear the term non-admitted, they think, well, maybe it's not a good thing, non-admitted. It doesn't sound very good. But it's actually just fine. And as a matter of fact, in some cases, non-admitted carriers or surplus lines carriers are better rated, more highly rated with AM Best or other rating agencies than admitted carriers, meaning that they have maybe a stronger balance sheet, fewer claims, or they just have a better financial profile. So it's an important distinction to understand that a surplus lines insurance carrier is different from an admitted carrier, but just because they may be referred to as non-admitted doesn't mean that it's a bad thing. One thing that's important to note is that because a surplus lines insurance carrier is not following state guidelines, they won't be covered by the state's reinsurance fund, which would step in the event that carrier went bankrupt or went out of business. So while it's important to note that as a distinction, again, you should take a look at the rating of the insurance carrier, the surplus lines carrier, and then make a decision on your own as to whether you think it's a worthwhile, safe carrier with a good financial foundation. Now, some types of surplus lines carriers you may recognize from the standard insurance markets. So surplus lines carriers can include companies like Chubb or Travelers or Liberty Mutual or Berkshire Hathaway and names like that. But actually the 800-pound gorilla in the surplus lines insurance space is a company called Lloyds of London. It's actually a syndicate, and in another video where I answer a similar question to this, I go into some more detail on Lloyds of London, and I'll link to that below this video. But anyway, that's kind of it in a nutshell. Basically, a surplus lines insurance carrier is just one that is not required to follow the state insurance guidelines regarding the types of risks that they write and the pricing that they provide. And it's also important to note that surplus lines is a regulated industry, just like the admitted insurance markets, and that surplus lines carriers have to be licensed in the state where they're located. So that's also important to know. Basically, in a nutshell, that's it. And I think surplus lines carriers are a great thing, especially for the industry that I specialize in, which is the renewables and green energy market, and also even in the space like crypto, these are all relatively new industries. So energy storage is a very new industry, and many insurance carriers just don't have the actuarial data to be able to underwrite those without having more access to a insurance market like the surplus lines market. Same thing for something like crypto. So anyway, that's it. Hope this has been helpful. Thanks again. If you like this video, please follow my channel. And thanks again, and have a great day.